Okay, guys, welcome to the next lesson. And in this lesson, we're going to be looking at what are spreads. Now, spreads are important to understand when it comes to entering and exiting your trade, because this can make all the difference of whether you get in the trade or you get stopped out too early or your take profit doesn't get reached. So having a basic understanding of how spreads work will really help you in the long term when it comes to trading. So what we need to understand is what a spread is. Now, a spread is a way that the broker takes commission from your trade. It's how they make their money. Okay. So what you need to think of it like, you got the exchange market, and then you got the broker, and then we got the end user, which is us. So the broker is the middle person. Now the broker will go to the exchange and place the trade on that exchange for us. Okay. So they get the wholesale price, we get the retail price, which is why we call retail traders. Um, so that is how they make their money. It's exactly the same as any commercial property, any business. They sell things, they mark the price up from wholesale price, so that's how they make money, and that's no different when it comes to forex trading in the market, and how the brokers make their money. So how does that look like for us? Now, I got the chart up here, but I've gone for the Great British Pound against the USD. So that's a pair we're looking at right now. And what I've done is, I don't normally have these lines on my chart, but just for this video, I got it on there. We have the blue line here, and we've got a red line there, and we've got this gray line here. Now, this is a live chart. As you can see, it is moving up and down. So at the moment, this line in the middle that you see, that is where price is right now. That is the current price of this particular currency pair. So let me get the buy tool up here. If I put that there. There's my um, there's my drawdown. So it hits up here. I'm out of a trade. Remember from previous videos, and here's where I want my trade to go. Okay, and it comes down here. I'm into profit. Now let's say I enter the trade right here. Okay, right on this very mark here where price is right now. And then what happens is you enter the trade right now, but your account will go straight into the negative. Okay, so when you open a trade, what usually happens is you go straight into drawdown. So let's say you go down into £10 drawdown. So what you got to wait for is for this red line up here to come down to the entry level. And once this red line comes down to this level and goes down, that is when we'll start making some money. So the gap between where you enter the trade, where you open the trade, and where you actually start making money, that is your spread. Now, usually, depending on what time of day or how long you open the trade for and whatnot, there's loads of different factors that determine how wide the spread is, the gap between the current price and where the ask and bid price is, where the buy and sell price is. Okay, in when the markets are moving quite a lot, when you've got lots of ups and downs, moving quite quickly, the spreads are quite small. So you will get more accurate entries. When price slows down, which is usually like later in the evenings or overnight or on a really slow pair, the spreads will widen, so they make more commission. So at the moment, I can see the spreads are a little bit wider than normal because it's late in the evening. So if I enter the trade right here, the I will still be in the negative, so I'll be up here. So I could be a couple of pips, or not even a couple of pips. It could be 0.1 pip in negative. As you can see now, price is going down. Now I would be in profit. Even though I entered a trade up here, I'm not in profit until price comes down to here. You can see this red line. So I'll be in profit now. So that's basically how spreads work. And we need to keep that in mind, because when the strategy that I particularly use, which I'll be teaching in the members area, um, it does rely on quite accurate entries. So having wide spreads doesn't really work on my strategies. You have to compensate for that. Let's say my strategy says you need to get in on your trade up here for a sell position at this level here, but it's not going to get activated until price reaches, let's put it up here. Let's move it up. Let's say I want price to come up to this level here to get activated. Now, the actual pips, sorry, the actual candles could actually come right up to my line, come past this line, and I'll still not be in a trade, okay? Because the sell price is down here. So it has to go all the way up here before I get entered into the trade, and then I won't see any profits until it's a lot lower down because of the spreads. Now, this all depends on the currency pair, on the broker. Some of them have wider spreads, some of them have very narrow spreads, which is what you're going to be looking out for. And it depends on your trading account. Some trading accounts, they offer zero spreads. So you'll get pinpoint accuracy, but they will take a percentage of, I don't know, let's say for every lot size that you place. So if you place a one lot size, they'll take £10, for example. Okay, so for every lot position you enter, they'll take $10 or £10. So we can take commission that way. So if your strategy does rely on pinpoint entries and pinpoint exits, and your stop loss are quite tight, you might want to look at getting a broker account, which is a raw spreads. So you literally have no spreads at all, but they will take a bit of commission, even if your trade doesn't play out or does play out. So they take it up front. So it all depends on your trading style. But as we'll be trading prop firms, they use demo accounts, and demo accounts don't tend to have spreads included in that. So if you're trading prop firms, you wouldn't have to worry too much about the spread. But definitely when you're trading a live account with live money, you need to consider spreads. Hopefully I explained that okay. If not, I'm happy to answer any questions. You can rewatch the video. And yeah, I'm just it can be a little bit confusing at first, but like I said before, the more you start trading, the more you get into it, the more you understand exactly how a spread will work. The other thing you got to think about is how wide you're going to put your stop loss because of these spreads. You're willing to have price come all the way up to here before coming out of a trade, before it takes you out automatically and you lose money. But if you look at a gap between where price is and where the stop loss is, the price is only got to come up to about here and then you're out of a trade. So you might need to compensate for that as well on bigger stop losses. So yeah, it's important to know that when it comes to trading. Like I said, if you've got any questions, just feel free to reach out to me. If you haven't, I'll see you in the next video.